So as we discussed, the story in the equity market for the first quarter of 2019 is recovery. This next chart shows the PE level for the S&P 500 over the last many years, and the average PE. So as we'll see, the average PE, just about 16, is right about where the market is. Now, in the fourth quarter of 2018, you'll see the line dip below that average. Well, that makes sense. We saw a pullback in the S&P of 20%. We know that other markets pulled back far in excess of 20%, and yet earnings were strong. Earnings grew last year over 20%. This year, we're seeing, again, growth, not as strong as last year, but still we're seeing growth. So if earnings are growing and the price is falling, the market is going to be getting cheaper, and we want to take advantage of that when that occurs. So we had the big dip in 2018, and we've had a rally in 2019, bringing us just back above the average. So what this is telling us, when you look at PEs at this level, we have to be very careful. We have to do rigorous work to find value. There is value in this market. And with interest rates this low, and with the Fed basically coming and telling us they're not going to drive interest rates higher, then an average PE is actually good. We still are positive on the market. We still think there's room on this market. There's going to be volatility. There's still going to be continued movement in this market, and we have to stay true to our discipline. But as the chart will show you, after 10 years, this is not like it was in 1999, as you see here, 26, 27 times earnings, or even back in 2016. Valuations are reasonable. So where can we find value? Well, in one area is growth versus value. This next chart shows the relationship between growth and value. Now, what we know is when one area of the market is performing extraordinarily well, as growth has over the last several years, it drives more and more capital to its style of investing. And so in this case, capital has been pulled to the growth markets, and valuations have gone up dramatically. This, by the way, has also driven the outperformance of the S&P and passive fund investing. Well, again, every trend has a top. And as we look at this next chart, we can't tell you exactly where the top of the growth market is, but we have to look at relative valuations and make the decision. Where do we want to put money, at the top or at the bottom of a market? What this next chart shows, the two red lines are two standard deviation events. The solid gray lines are one standard deviation event. What does that mean? It means when an asset crosses over the one standard deviation, there's a significant difference in price. Two standard deviations, as you can see, this chart goes back all the way to 2001, are very uncommon. They happen once in decades. Well, value is a two standard deviation event. It's that much cheaper than growth right now. If you look back at 07, when value was in favor, and then you look at the expansion of growth, these recoveries tend to take a long, long time. So what does this tell us? It tells us value is cheap relative to growth, and that we need to pay attention to that and make sure we're allocating capital where we find value. Just as value is inexpensive to growth, international is inexpensive to the U.S. So the U.S. has been the hottest market, rightfully so, great economy. We're coming off of that extraordinarily low 10 years ago. And international we have Brexit, we have China, we have emerging markets. So the international markets obviously not performing as well. Well, back in 06, 07, the international markets were hot. Everybody wanted to own emerging markets. Everybody wanted to own developed international. And you can see that in the valuation where the internationals touched that red line we just talked about. What does that mean? U.S. was two standard deviations cheaper. Well, what happened? The U.S. has outperformed since then. So much so that as we look at the end of this chart, here's the international markets again hitting that event line that causes us to look at valuations and say, long term, we think that there's value in the international markets because they're that much less expensive than the U.S.